Something is happening right now in the silver market that most people are completely missing. And by the end of this video, you're going to understand exactly what it is, why it matters, and what it could mean for the price of silver over the next 12 months. Let me start with a number, $80.90. That's where silver is trading today, March 18th, 2026. Now that might not sound dramatic on its own, until you realize that exactly 1 year ago, this same metal was sitting at around $34 an ounce. That is a 140% gain in 12 months. And the story behind that move, the real story, isn't just about inflation hedging or a weak dollar. It's about something far more structural, far more physical, and far more urgent. The warehouses that underpin the entire global silver trading system are running out of metal. And when I say running out, I don't mean they're getting a little low. I mean the drain has been so severe that at certain points this year, the market effectively seized up. So let's talk about what's actually happening, because this affects every investor watching right now, whether you own silver already or you've never bought a single ounce in your life. To understand the story, you first need to understand what COMEX is and why it matters. COMEX, the commodity exchange, is the primary futures market in the United States where silver is bought and sold on paper. When institutions, funds, and traders want exposure to silver, most of them don't go out and buy physical bars. They trade contracts on COMEX. Each standard contract represents 5,000 ounces of silver. Now here's the critical thing. Those contracts are supposed to be backed by real, physical silver sitting in registered COMEX warehouses. That's what gives the paper market its legitimacy. The assumption is that if you hold a contract and you actually want to take delivery of the metal, if you want the real thing, the silver is there waiting for you. For decades, that assumption held. The warehouses were well stocked, delivery was smooth, and nobody really thought twice about it. That era appears to be ending. COMEX registered silver inventories, the metal that's actually available for delivery, have been falling sharply. At the same time, something unprecedented happened on the investment side. Silver-backed ETFs, the funds that hold physical silver on behalf of retail and institutional investors, absorbed over 100 million ounces in a remarkably short window. Think about that for a moment. 100 million ounces pulled out of the broader market and locked away in ETF vaults. When you combine that with the COMEX drain, what you get is a physical market where the supply of immediately available metal tightens dramatically. And when supply tightens while demand keeps rising, prices don't just drift higher, they can move violently. We already saw a preview of that on January 29th of this year, when silver briefly touched an all-time high of $121.67 per ounce. That is not a typo. Silver hit $121. It has since pulled back to the $80 range, which actually tells its own story, but we'll get to that. So why is the physical market draining so aggressively right now? There are several forces converging at once, and understanding each one is important. The first is the structural supply deficit that has been building for years. Global silver mine supply runs at roughly 1,030 million ounces per year. Global demand, and this is the number that should stop you in your tracks, exceeds 1.2 billion ounces annually. That's a gap of somewhere between 160 and 200 million ounces every single year. And here's what makes this genuinely alarming. We are now in the 6th consecutive year of that deficit. 6 years in a row where the world has consumed more silver than it has produced. Those deficits have to be covered from somewhere. And historically, they've been covered by drawing down above-ground stockpiles. Those stockpiles are not infinite. The math here is not complicated, and it is not friendly to the idea that silver stays cheap forever. The second force is industrial demand, and this is where the silver story becomes something much bigger than a precious metals trade. Approximately 60% of all silver consumed globally goes into industrial applications. Not jewelry, not coins, not investment bars, industrial use. Solar panels are one of the biggest consumers. Every photovoltaic panel requires silver for its electrical contacts, and the global push toward renewable energy is not slowing down. Electric vehicles are another massive and growing source of demand. Each EV uses significantly more silver than a conventional combustion engine car. And then there's the category that most silver analysts were not pricing in even 2 years ago: artificial intelligence infrastructure. AI data centers require enormous amounts of power and cooling, and the semiconductors and circuit boards that make them run consume silver at every level of the supply chain. The industrial demand story for silver is not speculative. It is already happening, it is already in the data, and it shows no sign of reversing. The third force, and this one is very specific to the current moment, is the combination of U.S. tariff policy and silver's official designation as a critical mineral. When the U.S. government placed silver on its critical minerals list, it sent a signal to industries and governments around the world. This metal matters strategically, not just financially. That designation, combined with the threat of tariffs disrupting cross-border metal flows, triggered a wave of stockpiling in early 2026 that nobody fully anticipated. Companies that use silver industrially, manufacturers, technology firms, defense contractors, started building up physical reserves rather than relying on just-in-time supply chains. That stockpiling activity landed directly on COMEX and LBMA, the London Bullion Market Association, which is the other major hub for physical silver trading globally. The combination of ETF buying, industrial stockpiling, and the structural deficit meant that at certain points this year, buyers showed up looking for metal and simply couldn't find enough of it at the prevailing price. That is what a physical squeeze looks like in real time. Now let's talk about where things stand today and what the positioning data is telling us, because this is where it gets genuinely interesting from a market perspective. You'd expect that after a 140% gain over 12 months, institutional money would be aggressively long silver. But that's not what the data shows. Managed money net long positions on COMEX, that's the futures bets placed by hedge funds and professional traders, sit at around 24,600 contracts. That is a 2-year low. The big money is actually underpositioned in silver relative to where prices are. On the retail side, it's the opposite. 85.8% of retail traders tracked by Capital.com are currently long silver. So you have a market where everyday investors are heavily committed bulls, but the institutional money that typically drives big sustained moves has not yet fully committed. That gap is meaningful. It means that if and when the macro story convincingly turns silver bullish, and we'll get to what that catalyst might be, there is a significant amount of institutional firepower waiting on the sidelines that hasn't been deployed yet. That macro catalyst is sitting right in front of us today. The Federal Reserve concluded its March 18th FOMC meeting, and the direction of U.S. monetary policy is the single most important near-term variable for silver prices. Here's why. Silver, like gold, tends to perform well when real interest rates are falling and when the U.S. dollar is weakening. Right now, markets have priced in approximately 60 basis points of rate cuts from the Fed across 2026. That means investors collectively expect the Fed to ease policy meaningfully this year. A weaker dollar makes dollar-denominated commodities like silver cheaper for foreign buyers, which stimulates demand. Falling real rates reduce the opportunity cost of holding a non-yielding asset like silver. Both of those dynamics are tailwinds for the metal. If today's Fed statement or Chair Powell's press conference signals even a moderately dovish tilt, a willingness to cut sooner or more aggressively than the market currently expects, silver could respond sharply to the upside. The key technical level to watch is $82.70, which is where the 50-day moving average sits right now. A clean break and close above that level on meaningful volume would be a strong signal that the next leg higher has begun, with $86 as the next significant resistance. On the downside, $79.50 is the near-term support floor. If that breaks, the next serious zone of buying interest comes in around $75. So what happens next? Let's be honest about all three scenarios, because anyone who tells you they know exactly where silver is going is selling you something. The bull case is straightforward and frankly compelling. The structural deficit continues or worsens. Industrial demand from solar, EVs, and AI keeps growing. The Fed eases policy and the dollar weakens. Institutional investors rotate back into silver as they realize they're underpositioned, and COMEX inventories continue to drain, eventually forcing a repricing of physical metal. In that scenario, the Bank of America target of $135 to $309 before year-end is not as crazy as it sounds. Gold Silver's analyst has put $175 on the table as a serious possibility rooted entirely in the deficit math. Even if you think those numbers are optimistic, the direction of travel in that scenario is clearly much higher from here. The bear case requires some intellectual honesty too. If the Fed turns hawkish, if inflation reaccelerates and the expected rate cuts get pushed out or canceled, that strengthens the dollar and weakens the case for silver as an inflation hedge. A global industrial slowdown, particularly in China, could dent the demand picture faster than the supply story can compensate. And if institutional traders who are currently underpositioned simply stay that way, the retail-driven bullishness can only carry prices so far. JP Morgan's conservative average forecast of $81 for the year reflects a scenario where macro headwinds offset the structural tailwinds, and silver simply treads water near current levels. The most likely near-term scenario, and this is the honest middle ground, is continued volatility around the $80 level, with the FOMC outcome today acting as the near-term directional trigger. If Powell sounds dovish, watch for a test of that 82.70 resistance. If the statement surprises to the hawkish side, 79.50 becomes the line in the sand. What feels clear over a medium-term horizon of 6 to 12 months is that the physical market fundamentals have not changed. A deficit of 160 to 200 million ounces per year does not resolve itself quickly. COMEX inventories do not refill overnight. Industrial demand from the energy transition and the AI build-out is not going away. The question is not really whether silver has a bullish structural story. It clearly does. The question is about timing, and timing in commodity markets is always the hardest part. What you're watching right now is a market where the physical reality and the paper price are in tension. That tension has a history of resolving itself in one direction, upward, and often faster than most people expect. The $121 print in January was a warning shot. The pullback to $80 is either a buying opportunity or a signal that the euphoria got ahead of itself, and figuring out which one requires watching exactly the variables we've talked about today. If you found this breakdown useful, hit subscribe right now. We cover the metals market every week with the same level of detail and the same commitment to using real data rather than hype. And I want to hear from you in the comments. What's your price target for silver by the end of 2026? Are you in the $80 to $100 camp, the 150 plus camp, or do you think the bear case wins out this year? Drop your number below. I read every single comment, and I'll be referencing the best ones in next week's video.